everyone, my name is Prashantanan and I am a faculty here in Career Plus Institute, Bareilly. Today I would like to welcome you in the account series. This is the second chapter that we are going to cover today, and the topic of the chapter is accounting concepts. Now let us discuss what are these accounting concepts. Accounting concepts are those standards or those assumptions on the basis of which the accounts are being prepared. Or you can understand it in this way, that accounting standards are being used all over the world, or accounting concepts are used all over the world, which allow them to be in standards, and there are certain assumptions which are required to be used for passing all your accounting entries. Now, discussing these accounting concepts, before that I would like to tell you why it is important to use accounting concepts. Now, there is one thing that you have to understand. For every business, there would be many transactions which are being recorded. Now, in the previous chapter also we have discussed that there are thousands and thousands of entries which are to be recorded. Since there are so many entries which are to be recorded, and they should be in an order so that it can be useful for the investors, for the creditors, for the management. So these are the users of the information, and if the information is not useful to them, then there is no point in maintaining these records. So for that, we have some certain assumptions are there on the basis of which we prepare our accounting statements. Now let us discuss the definition of accounting concepts. Accounting concepts refer to the basic assumptions, rules and principles which work as the basis for recording of business transactions and preparing accounts. So it acts as a basic principle which allows them to be recorded which allows the transactions to be recorded in the accounting books. Now let us discuss certain types of accounting concepts. First is business entity concept. This is a very normal concept, and everyone should know about this concept, because whenever you are going to pass further entries, future entries in accounts books, maybe journal, cash book, passbook, whatever books you are going to prepare, whatever financial statements you are going to summarize, you will be using business entity concept in that. Now, what is the meaning of business entity concept? Business entity concept is nothing but there is a separate entity, separate artificial entity of the business. It is separate from the owner. Let's say XYZ is the company's name, and the owner of that company is Rahul. So Rahul being the owner of the company doesn't mean that the company's name will also be Rahul. Rahul is a separate entity in the eyes of law, and so is the business. So being business a separate entity, liabilities of the business are not held with the owner of the business. Owner might bring some investment. That investment is not something which is gained by the company. It is just the liability for the company. Now let us understand this with an example. Let us say Rahul is bringing 50,000 rupees of capital, or he is investing 50,000 rupees from his own pocket, from his own savings in his business whose name is XYZ Company, XYZ Company Limited. Now in this company, he is bringing 50,000 rupees. 50,000 rupees are going to be used in XYZ company, but Rahul will take that money back from the company. So for company, that is not an asset. Now, what are assets and what are liabilities? Quickly, let us discuss this also. Assets are those things which are owned by the company. Liabilities are those things which are owed by the company to others. So business entity concept says whatever things are being brought by the business owner, those are nothing but liabilities to the business, because the business has not earned those things yet. So it owes that money back to Rahul. Let us say Rahul has brought 50,000 rupees in the business. So business owes 50,000 rupees back to Rahul. One day or the other, the business will have to give that money back, or it will have to give returns on that. Obviously, it will give return on the investment of Rahul. So Rahul will gain something from the business. This is how business entity is defined in this book. Let us move forward with the next concept, that is, okay, before we move forward, let us quickly discuss the significance. This concept helps in ascertaining the profit of the business, as only the business expenses and revenues are recorded and all the private and personal expenses are ignored. Now, recording all the transactions of the business is the main purpose of maintaining accounting books. You are not concerned with the personal expenses of Rahul. Rahul is maintaining a books of accounts for his company, so he cannot include his own expenses in that, because Rahul's company's capital is different and his own savings are different. Rahul have some savings and those savings he can use for his personal expenses, but he will not include these in the accounting books. Otherwise, it might show inflated or deflated profits, which he doesn't want to show in the books. What he wants is only to show the pure profits of the business. Next is, this concept restrains accountants from recording of owners' private personal transactions. Again, same thing, it restricts the people, it restricts the chartered accountants or accountants to record the personal expenses of the owner of the business in the books of business. It also facilitates the recording and reporting of business transactions from the business point of view, and also it allows you to understand the transactions from the business point of view and not from the point of view of Rahul. Something might be difficult for Rahul to move forward with, or might be difficult for him to take a decision regarding something, but from the perspective of business it might be beneficial. So a person who owns the business will not see whether it is beneficial for him, he will see whether it is beneficial for the company or not. That is why a professional management is employed, so that they can take better decisions. Otherwise, owner will only see its own interest. Maybe there are some expenditures which are coming up in the business which are not in interest of Rahul, but management will take those decisions regarding those expenditure because that is going to result in future profits. So Rahul might be biased because he is investing, he is the owner, he is investing so much money, so he might be biased, but business entity concept allows him to invest in business and allows him to do whatever he wants to do with the help of business. So every transaction is seen from the perspective of business and not the perspective of owner. Next is, it is the very basis of accounting concepts, conventions and principles. If anything is important, then that is business entity concept. Why? Because all the concepts, all the principles, all the rules and regulations are dependent on business entity concept, because we have to consider business as a separate entity, and that is when we will be taking certain assumptions, certain principles we will be following. Next is money measurement concept. Now, there are so many transactions happening in the business. There is one transaction in which a manager is being appointed. This is also a business transaction. But can you record this in the accounts book? No. The reason is you cannot measure it in the terms of money. So anything which can be measured in terms of money and which is significant, only those things will be recorded in the books of accounts. This is something which money measurement concept tells us. You will record only those things which can be measured in terms of money. Let us discuss the significance of this. This concept guides accountants about what to record and what not to record. So accountants can easily figure out what is to be recorded and what is not to be recorded. It helps in recording business transactions uniformly. Uniformly means in a constant manner, to follow a certain standard and maintain the records in a certain manner. Today you are recording things which are only related to money. Tomorrow you are also recording certain things which are not related to money. You cannot do this. The money measurement concept keeps it constant or keeps it uniform. If all the business transactions are expressed in money terms, it will be easy to understand the accounts prepared by the business enterprise. If all the transactions are in terms of money, it will be very easy for you to measure the transactions. It will be very easy for you to understand how much sales has happened, how much purchases have happened, how many expenses were there, or how much did you spend on those expenses. So this is very easy for you to understand if it is in terms of money. Then if all the business transactions are expressed in monetary terms, it will be easy to understand the accounts prepared by the business enterprise. This we have already discussed. It facilitates comparison of business performance of two different periods of the same firm or of the two different firms for the same period. Now it becomes very easy for you to compare your business with another business which is following the same standards, same concepts, because the statements will be uniform. They will also be recording only the monetary transactions. You will also be recording monetary transactions, so it becomes comparable. Another thing is, you can compare your this year's data with previous year data, or maybe 5 previous years data. It becomes very easy because you are following a standard, you are following a concept which keeps your accounting standard. Okay, it keeps your accounting standardized. Next is going concern concept. Now company also is a going concern. Going concern means it will keep on going. It will never come to an end. This is the assumption. We have assumed this, that the business will keep on going. It will never come to an end. Even if the investor dies, or even if the owner of the company dies, it doesn't matter, the company will keep on going. And because of this concept, we are preparing accounts every year. Otherwise, what will happen, if the owner is about to die, the people might not consider making the accounting books. They might not consider working hard in the business. So going concern concepts allows the employees to understand that this company is not going to come to an end. So that means they have some job security. Even if the investor, even if the owner dies today, the company will keep on going. This is what is meant by going concern concept. So how is it going to go on? If this investor dies, if this owner dies, there would be somebody else who will acquire the company, and then it will keep on going. This is how it works. Let us discuss the significance. This concept facilitates preparation of financial statements. You prepare financial statements every year. You are summarizing all the transactions every year because you know that this company is going to go on. You know that it is going to go on. That is the reason you are preparing. Otherwise, there is no point in preparing accounting every year. Finally, whenever your business is going to come to an end, you will simply make the accounts then, and you will distribute the profits. But since we know that it is going to go on and we have to distribute the profits every year, we prepare our accounting statements. Another is, on the basis of this concept, depreciation is charged on the fixed assets. Now, depreciation is what? Depreciation is the money which is charged on the assets, or you can say we diminish the value of the assets with the help of depreciation. Why is it so? Let us say that I have bought a new machine which is worth 50,000 rupees and its expected life is 5 years. So what is going to happen after 5 years? I will have to replace this machine. Would I or not? Definitely I would have to replace this machine, or I have to spend money on repairs. Now with this, I can see that 50,000 rupees worth of machine is not going to last forever. So the value of that machine will keep on going down every year. So in your asset section, because you are maintaining an asset, which means that the things that you own, the company owns, so the value of the owned things are going down. The value of the owned things are going down. So you will reduce the value of assets also, because after 5 years, the value of that asset will be to the scrap value, maybe 5,000 rupees. You can sell it for scrap, for which you will get 5,000 rupees. So the scrap value of the machine you have calculated. Scrap value is nothing but the money that you can attain from selling off your redundant machine. Redundant means which is totally used up, which is obsolete, which cannot be used further. So once the machine becomes redundant, you will try to sell it in the market so that you can attain some money out of that. So that is known as scrap value. So after deducting the scrap value, whatever value is remaining, that you will keep on deducting every year. Let us say that 45,000 is the money which is to be deducted over 5 years. So you can deduct 9,000 every year. That is straight line method. We will be discussing depreciation methods later in the further chapters, but I'm just giving you an example that 5 years is the expected life of the business, of the machine. So how are you going to reduce the value of this machine? Initially, you will start with the depreciation 9,000 every year, and for 5 years, if you will calculate 9,000, it will come to 45,000. So 45,000 you will write down over 5 years. That means every year the value of the machine is going down. The value of your assets is going down. On the basis of this concept, okay, this we have discussed, it is of great help to the investors because it assures them that they will continue to get income on their investments. Investors are assured that the business is constantly moving forward. It is going to go on. It is never going to come to an end. That's why it assures the investors, and that is the reason investors would like to invest their money. Otherwise, let us say that investors wants to invest the money, but they know that after 1 year, the owner is going to die because he is suffering from diseases and he is going to die. That means the company will come to an end. So why would the investor invest his money, his hard-earned money in the business? He would never go for investment in this company. So because we assume that the business is constantly, it is going to go on, it is never going to come to an end. So we invest money. So the investors invest money because it is an assurance that the company will keep on going. In the absence of this concept, the cost of a fixed asset will be treated as an expense in the year of its purchase. Now, in absence of this concept, What you are going to do? Let us say that I bought this machine for 50,000 rupees and I am missing out this concept, going concern concept. That means even though I know that the expected life of my machine is 5 years, I will have to write off 50,000 this year itself. From my assets, I will have to reduce the value of 50,000 rupees this year itself. Why is it so? Because I believe that the business is going to come to an end next year if we are not following ongoing concern. If we are following this concept, that means that I am going to keep on going with my business further in the future and I will write off this machine over 5 years. Another is, a business is judged for its capacity to earn profit in future. Now whenever you start a business, you do not start making business profits from the same period. You always calculate, you always see if we are investing today, there will be some returns in future. Because you know that there would be some future earnings, not the present earnings, you follow this going concern. It helps you to assume that your business is going to go on. Now let us discuss the next concept, accounting period concept. Accounting period concept is nothing but simply we keep some accounting period. For example, financial year is being followed. Every business follows a financial year. In India, most of the companies are following April 1 to 31st March. This is the financial year. So this is the accounting period. That means whatever transactions are going to happen in this period will be recorded at the last of the year. That means at the last of the year it will be finalized, or you can say summarized. Accounting period concepts tell you that on a constant basis or on a uniform basis you will have to prepare the accounts. That means after a certain amount of gap, you have to prepare your accounts. Let us say that gap is constant and that is 1 year. So every year you will have to prepare the accounts and you are finalizing, you are summarizing it for the help of all the users of accounting information. Who are these users of accounting information? Investors, creditors, bankers, management, owner, all these people are going to use this accounting information because they know that every year we will get the accounting information. So this is accounting period concept. It tells you that you have to prepare accounts on a certain period of gap. Every year you have to prepare. In India, you have to prepare it every year. With this, I would like to end the first part of this chapter and we will begin with the remaining part of the chapter in the next part. Please keep updated with the next part. Thank you.